well, trying to make up its mind around the 7 handle. Chidu Narayanan is head of macro strategy, APAC at Wells Fargo Securities. Joins us with his take on the markets. Chidu, lovely to have you on the show. Thank you very much for your time. Let's start off with the NPC because it's already the aftermath, the day after the NPC and the government work report was tabled in Parliament in China. What did you take away from that report? And what does it mean for the stability of the currency, which they're so committed to, policymakers in China?
No, fair. That's I think, what all of us were looking at the beginning of this week. To be fair, there wasn't too much of a surprise. Growth was kept around 5%, as pretty much everybody expected. Fiscal deficit coming at around 3%, but additional ultra long-term bonds as well as state government bonds, which would push it up. Probably anywhere between 7 to 10%, depending on how you're doing the math. 5% is not an easy target this time around. It was the same target last time,
around
but you had
5%.
Around 5%. Yes,
yeah.
It's not as easy as it was last year, because last year you had a few tailwinds. You had the opening up of the economy, you had a low base, so it's a slightly harder target than it was last year, which the Premier acknowledged. As things stand with fiscal, it sounds like they might have to do more to achieve the 5%, but I think it's a very pragmatic setup that they've outlined so far. These are just guidelines, and do expect that there might be a little bit more fiscal support if they are having more headwinds. Take it as it goes, see how the economy, how external headwinds or tailwinds pan out and add further stimulus. They do seem committed towards 5%, but also around 5%, but also on quality of growth. So they do not want to necessarily be going there only with fiscal support, which is not medium-term focused. So that's their focus.
And so what does that mean for the range as far as the yuan is concerned right now?
Near term, we expect that there's going to be still a little bit more of downside risk to the CNY, so upside for dollar CNY. The PBOC has kept dollar CNY fixes pretty much flat over the last month and a half. We expect that that will be the case. A lot of it will be driven by what happens with the dollar itself and the dollar index, which then takes us to what happens with dollar data, because a lot of the crosses are driven more by the dollar rather than by the local effects, whether it's China, whether it's other parts of Asia, and that puts us bang in line with what we're expecting with Powell today, with NFP later this week, and when the Fed might eventually start to cut.
Okay.
Can I ask you to that effect? Because obviously, you know, it's almost a fool's errand guessing what Powell's going to be facing in terms of some of the lawmakers. Maybe they're going to try and get re-elected and get a little bit more fierce with him than usual. But just in terms of what one of the other Fed speakers, and I've been asking people this all week, Governor Waller had an interesting set of commentary when it came to the balance sheet, and suggesting that, you know, you've got to get rid of agency MBS off the sheet and you've got to start scooping up T-bills, maybe more aligning it with, you know, the transmission of Fed policy, having the short end a greater propensity of that on the Fed's balance sheet as well. And considering what we're seeing in terms of Treasury, obviously having that tilt towards T-bills, do you think that that's a likely set of circumstances? Because that affects liquidity across the board if that's the path that the Fed is going to be choosing to take.
So our call on QT and a call on the Fed is that QT probably starts announced June, starts July. Fed starts to cut in May, starts in June, cuts in May, and then continues through H2. We think that the Fed is very conscious about liquidity. They've seen where liquidity tightness has led to in repo market stress in 2019. They've seen how uncertainty over the refunding announcement has led to Treasury market sell-off and increased volatility as well. We expect that there's going to be increased rate volatility, but we also think that the Fed's very, very conscious about that, which is why they start to taper. The Fed's also conscious about being very data dependent. In terms of what they want to do with a soft landing, which is a lot more probable now than same time last year. They do want to ensure that it's an easy landing. They want to, the primary goal is to get inflation down. But as long as they see the path to inflation getting 2% is there, that should suffice for the Fed. At this point in time, it's a little uncertain because of the strong NFP and the inflation numbers that you've had both on CPI and PCE. So we'll have to wait for a little bit longer. It could push the first Fed cut probably into the summer. But that's what they're looking at. It's all about data for now.
I know this is getting like a little bit technical, but just in terms of, because the expectation would be that if we do follow this Waller strategy, we do follow this part of the plan, that you are going to see that steepening occurring. The short end comes off considerably. That obviously affords, and even a number of financial institutions that that borrow short then long, that you would see the curve normalizing. And do you have any kind of expectation that the curve will normalize this year? Because the other side of the coin is this expectation that you'll have the 10-year at 3.5, and you'll still have the 2-year having to be stuck at somewhere around 4. So you're still going to have it the other way.
So we do expect that the curve will be steepening. The question is, when does it start steepening and how much does it steepen? And there are various factors there. So what we've looked at is, before the Fed cut, what is the implications for the Treasury curve just leading into any Fed cut, not this time around, but in past cycles as well. And we see that there is not too much of a yield change, a directional yield change 3 to 6 months before the first cut. There is more change in the 0 to 3 months leading into the first cut, but the curve steepens in both cases. The 530s particularly steepens quite substantially, and that is our sweet spot. We do like the curve to be steeper here. The curve steepens even further if heading into election season you have a lot more chance of a sweep by either party, because then that means that there's going to be increased fiscal support, increased issuances at the long end, and the Fed and the curve steepens even in that scenario. So we do like the curve to be steepening at this point in time. The 530s is our preferred expression of that trade.
Chidu, I wish we had more time, but unfortunately we don't. But we're going to have to continue on this conversation next time. Thank you so much for coming. Really do appreciate it.
Reason enough to come back again.
Exactly. That was Chidu Narayanan of Wells Fargo Securities.